Welcome to the deep dive. Today, we're looking at something that sounds, well, pretty solid, maybe even a bit old school real estate. But hang on, because we're diving into a transformation that's really shaking up how we think about property investment.
It really is a huge shift. We're drawing today from the work of Swiss economist Dr. Pooyan Ghamari, especially his views on real estate tokenization. And his point is, this isn't just a minor adjustment, it's a fundamental change.
Right. I mean, traditionally, real estate, it's always been so illiquid, hasn't it? Kind of exclusive. You needed a lot of cash, selling took ages, it was all just cumbersome. So our mission here is to unpack how that's changing, how bricks and mortar are becoming, dynamic, accessible, bankable assets.
Yeah, and what's really interesting is that Dr. Ghamari points out is it's not just one thing, it's this convergence, really. Technology, specific legal structures, and choosing the right location. It all comes together. And this isn't just about, buying property a bit differently. It's potentially unlocking trillions in value, changing investment, and maybe even democratizing wealth access in a way we haven't seen before in real estate.
Trillions. And democratizing wealth. Okay, that definitely gets my attention. So how does this all work together? We'll break down these core pillars Dr. Ghamari talks about. Tokenization, then the legal side with special purpose vehicles, and why these forward-thinking jurisdictions are so important. All right, let's get into it. So maybe before we jump into the new stuff, let's just quickly touch on the old way. What were the main sort of headaches with traditional real estate investing?
Oh, the barriers were just massive. You needed huge amounts of capital, right? Often hundreds of thousands, even millions, just for one property or a decent stake in something commercial. It just locked out so many people.
And once you were in, getting out wasn't quick.
Not at all. Real estate is just fundamentally illiquid. Selling takes months. You've got agents, lawyers, all the due diligence, paperwork. The friction is immense. And trying to sell, say, just a small slice of a building, almost impossible for an average investor. So it really limited the market to people with, long horizons and deep pockets who could afford to sit tight.
Felt like a very exclusive club. Lots of patience, lots of capital needed.
That lack of liquidity, the high transaction costs, they were major drags on the market, limiting who could participate.
Okay, which brings us nicely to the first big change agent, tokenization. This is where the tech comes in to disrupt things. So how does tokenization actually work for, a building?
Right. So imagine taking a physical asset like an office building and basically creating digital certificates that represent tiny ownership slices of it. It uses DLT, distributed ledger technology, blockchain usually, to make these digital tokens. So instead of your name on one big paper deed, you might own, say, 100 digital tokens representing your fractional share.
So you're slicing up a multi-million-dollar property into potentially thousands or even millions of little digital pieces.
That's exactly it. Each token is a fractional ownership stake. And the huge implication here is a property that maybe one entity owned before now could be owned by thousands of people all over the world, each holding tokens for their piece.
And that fractional aspect, that's the engine for liquidity, right? Because you can actually trade these tokens.
Yes, precisely. It works much like shares in a company on a stock market. You're not trying to transfer the physical deed each time. You're just transferring the ownership of the digital token on the blockchain. This totally bypasses that slow, clunky, expensive traditional process. It makes the idea of a liquid real estate market. Well, suddenly it seems possible. You could potentially buy or sell your fraction in minutes.
Okay, so tokenization gives us the fractional bits and the potential for liquidity. But Dr. Ghamari emphasizes, and it makes sense, that just tokenizing isn't enough. You need this crucial legal piece too.
Absolutely vital. And that's the special purpose vehicle, the SPV. It's essentially a legal wrapper. Think of it as a specific company or a trust that's set up for one single purpose: to own that underlying real estate asset.
Ah, okay. So the building itself isn't directly tokenized. The SPV owns the building.
That's the critical structure, legally speaking. The SPV holds title to the physical asset. And this gives you some really key advantages. First off, it isolates risk. So if the SPV has debts related to that specific property, it generally doesn't spill over and affect the original owner's other assets or the parent company. It kind of ring fences the risk.
Makes sense for the person setting it up. What about for the people buying the tokens?
For the token holders, the SPV structure simplifies everything. All the headaches of property management, the legal stuff, distributing income, that's handled by the SPV. Your token represents your interest in that SPV, which in turn holds the asset and generates the income. So you have an indirect interest.
And that structure, the SPV owning the physical thing, the tokens representing a piece of the SPV, that's the legal trick that lets the tokens be traded freely.
Exactly. That's the clever legal engineering. It bridges the gap, you see, between the physical illiquid asset and the potentially very liquid digital token. The building stays safe, held within its dedicated legal entity, the SPV. Meanwhile, the tokens, which represent the economic rights, can zip around on secondary markets without needing to mess with land registries constantly. It provides a solid, secure framework for this whole market.
Got it. So you need the tech tokenization for the digital pieces and the trading, and you need the legal structure, the SPV, to hold the assets safely and give those tokens their legal meaning. They have to work together.
Absolutely. One really enables the other.
Okay, and then the third crucial pillar, according to Dr. Ghamari, is location, location, location. But for the legal structure, why does it matter so much where you set up this SPV and issue the tokens?
Oh, it matters hugely, because not every country is caught up, legally or regulatorily, with digital assets and these security tokens. You really need jurisdictions that are looking ahead, that have actively built supportive environments. These places offer the legal certainty, the regulatory clarity. That's just fundamental for attracting investment and letting this market actually grow.
So which places are kind of leading the pack here, based on the source?
Well, Dr. Ghamari points to places like Switzerland. They have their DLT Act, which is quite specific legislation for this stuff. Liechtenstein is another leader. Singapore, the UAE, especially Dubai, and the Abu Dhabi global market, they're actively setting up regulatory sandboxes and frameworks. Even some Caribbean nations are getting in on the act with specific laws.
And what are the practical advantages these places offer? Like, what makes them attractive?
Regulatory clarity is probably number one. You actually understand the rules of the game. Often they also have pretty favorable tax rules for digital assets or these kinds of investment vehicles. They need robust legal systems, obviously, that protect property rights, but also, crucially, the rights tied to digital assets and smart contracts. And just their general attitude, being open to financial innovation, that acts like a magnet. It draws in talent, capital, projects. It's the foundation this needs.
Right. So you need the tech for the fractions and trading, the SPV for the legal structure and security, and the right location for clear rules and a good environment. When you get all three clicking together, what does that actually unlock? What are the opportunities?
The opportunities are pretty broad, touching different groups. For investors, the big one is just opening up access to capital by drastically lowering how much you need to invest. Maybe buying a token for hundreds or thousands of dollars instead of millions. Real estate suddenly becomes reachable for way more people globally. Retail investors, smaller funds, people who were just shut out before by cost or geography. This potentially taps into massive new pools of capital.
And even for people already investing, it must make diversification way easier.
Totally. Instead of needing a huge chunk of cash for one building in one city, you could take that same smaller amount and buy tokens in, say, 10 different properties, different types, residential, commercial, maybe logistics, and in different countries. It just allows for much more fine-grained, flexible portfolio building and risk management.
It also sounds like it could really change things for developers trying to raise money.
Oh, huge for them. Developers can potentially raise funds more efficiently by issuing these security tokens linked to their project. It lets them reach a global investor pool directly, maybe bypassing some of the slower, more complex traditional routes like bank loans or private equity. It could really speed up project financing.
And the underlying tech itself, the blockchain, brings its own benefits, right?
Yeah. Transparency and efficiency are big wins. The blockchain's immutable ledger gives you this clear, verifiable record of who owns what, when transactions happened, even how income is distributed. That helps cut down fraud, reduces a lot of the administrative costs you have with traditional paper-heavy systems, and generally builds trust.
And the one you touched on earlier, the really big picture idea, democratizing wealth.
Yeah, that's possibly the most profound long-term potential here. By breaking down these massive, expensive assets like prime real estate into affordable digital units, tokenization could empower people with less capital to actually participate in a major wealth-building asset class. Historically, that's been really hard. This could have significant societal benefits, maybe helping to narrow wealth gaps, especially in places where traditional access is really limited.
It potentially takes real estate from being this exclusive thing to something anyone with an internet connection and a bit of capital could get involved in.
Okay, let's go even deeper now. Dr. Ghamari's work and the sources, they touch on some really advanced strategies and future possibilities that build on this foundation.
Yes, this is where it gets really interesting. Seeing how this basic structure interacts with more sophisticated financial tools and other emerging technologies, it creates some fascinating new angles.
Okay, so thinking about today's world, how can this fractional ownership approach specifically help investors deal with, say, geopolitical risk? Well, traditionally, if you own a whole building in, let's say, country X, you're pretty exposed, right, to that country's politics, its economy, currency swings. With tokenization, you can instead own tiny fractions of property spread across many different countries, potentially in very different geopolitical zones.
So instead of all your eggs in that one country X basket, you've got like tiny bits of eggshells in 50 different baskets all over the place.
Exactly, that's a good way to put it. It massively reduces your concentrated risk. If one region hits turbulence or its currency tanks, your exposure is limited. And because these tokens are potentially liquid globally, you might be able to sell out of the affected assets relatively quickly and move capital somewhere more stable. That's almost impossible with traditional property. It shifts the risk profile significantly.
That agility sounds like a huge advantage for managing risk. Now, what about DAOs, decentralized autonomous organizations? How do they fit into governing these tokenized properties?
Right, DAOs could potentially revolutionize how these assets are managed. Instead of a traditional management company or board making all the calls, behind closed doors, a DAO lets the token holders themselves vote collectively on key decisions, using the blockchain for transparency and verification.
So wait, the actual investors, the token holders, could vote on things like, should we renovate? What should the rent be? Or even, should we sell the building?
Precisely. Any major decision could be put to a vote. It's transparent, it's recorded on the blockchain, and your voting power is usually tied to how many tokens you hold. For investors, this means having a direct say and a level of transparency into operations that you just don't get in traditional real estate funds or structures.
And it sounds like it could maybe cut out some middle management layers too.
Potentially, yes. It could reduce management fees, cut down on administrative overhead by automating things through smart contracts and these token holder votes. Ultimately, that could boost returns. And all the governance stuff, proposals, votes, results, it's all recorded immutably on the blockchain. That builds incredible transparency and trust.
Okay, so beyond just holding tokens, what about trading? What kind of more sophisticated strategies does this liquidity enable on secondary markets?
Well, the liquidity really changes the game. Real estate goes from being this static sit-and-wait asset to something you can actively trade and even integrate into the wider digital asset world. You could potentially do arbitrage looking for small price differences for the same token on different platforms, or maybe between the token price and an estimate of the underlying asset value.
Like day trading fractions of buildings.
At a fractional level, potentially yes. It also opens doors into DeFi, decentralized finance. You might be able to engage in things like yield farming or staking, basically locking up your tokens to help secure a network or provide trading liquidity and earning passive income, other tokens usually, in return. You can become a liquidity provider in automated market-making pools on decentralized exchanges, earning fees. On regulated platforms, maybe even leveraged trading becomes possible, although that obviously ramps up the risk considerably. The point is, you gain this ability to quickly rebalance, to get in or out, and explore new ways to generate returns that were just unthinkable with illiquid physical property.
It's layering a whole financial market dynamic on top of the basic real estate return. What about AI and machine learning? How do they plug into this tokenization picture?
AI and ML? Yeah. Integrating those with tokenization platforms unlocks some really powerful tools, especially around valuation and prediction. If you feed AI algorithms tons of data past sales, rental yields, local market trends, even broader economic indicators, maybe social sentiment data, you could potentially get dynamic, real-time valuations that adjust constantly.
So the value of my token isn't just based on an appraisal once a year. It could actually fluctuate based on live data.
Exactly. Reflecting market conditions and fundamentals much more closely. AI could also offer hyper-personalized investment advice, flagging potentially undervalued properties, suggesting optimal buy or sell times, forecasting yields with much more granularity. It can also help with risk assessment, spotting anomalies that might indicate fraud, and even optimize portfolio suggestions based on your specific goals and risk appetite. It makes real estate investing potentially much more data-driven, much more proactive.
That's really interesting, turning property into something more like a dynamic data stream. And this whole framework, it also seems designed to kind of bypass traditional banking bottlenecks for cross-border deals.
Absolutely. It makes cross-border flows potentially much smoother. A key way is using stablecoins for settlement. These digital currencies pegged to fiat like the US dollar. That means transactions could happen almost instantly, anywhere in the world, without the delays and costs of traditional international wires and without worrying about currency fluctuations during the settlement window.
So buying a fraction of a property overseas could become almost as easy as just sending tokens and stablecoins back and forth.
That's the potential, yes. It also means tokenized real estate could potentially be used as collateral in global DeFi lending platforms. So you could borrow against your asset value without selling it, regardless of where you or the property are. Direct peer-to-peer trading between investors globally becomes much more feasible, cutting out intermediaries. And then there's the strategic use of different jurisdictions.
Right. Let's dig into that jurisdictional arbitrage a bit more. How exactly does picking the right legal location for the SPV and the token issuance affect the investment itself?
It's a really critical choice, impacts the bottom line and the legal footing. Setting up your SPV or issuing tokens at a place with favorable tax rules, maybe lower capital gains tax, corporate taxes, or withholding taxes on income paid out to foreign investors that can significantly boost the net returns for a global investor base.
So where you incorporate the structure can be just as important as where the actual building is.
In many respects, yes. You also want jurisdictions with really clear, stable legal frameworks specifically for digital assets and security tokens. That gives everyone crucial legal certainty, making sure digital ownership rights and smart contracts are actually enforceable in court. You obviously need strong underlying property rights protection too. And finally, choosing places with fewer capital controls and efficient banking makes it easier to get money in and out of the whole ecosystem. It's a strategic move to optimize both compliance and returns in this globalized market.
It sounds like you're picking the most efficient and legally sound digital home for the assets structure. Okay, shifting gears slightly. What kind of broader economic signals should investors watch for as potential indicators that it's a good time to get into tokenized real estate specifically? Are they different from traditional signals?
They overlap, but yeah, there are specific things to look for related to this convergence. Besides the usual real estate cycle stuff like interest rates or supply demand, you'd probably look for signs of declining liquidity in the traditional real estate markets, because that really highlights the value proposition of tokenization.
So if the old system is getting creakier, the new solution looks more attractive.
Exactly. You'd also watch for growing adoption and stability in the wider crypto market, especially stablecoins, because that shows the underlying tech and payment rails are maturing. Big green lights are positive regulatory developments in key jurisdictions. New laws supporting security tokens, licensed exchanges popping up that reduces uncertainty, seeing traditional finance players, the big institutions, starting to dip their toes in. That signals growing confidence and potentially deeper future liquidity. And finally, the growth of DeFi protocols that are specifically built to handle real-world assets, like tokenized real estate, that indicates more ways to actually use these tokens and potentially earn yield.
Interesting. A different lens than just watching housing starts. How does tokenized real estate compare as an inflation hedge versus traditional real estate?
Well, traditional real estate is often seen as a decent inflation hedge, right? Property values, rents, they tend to rise with inflation over the long haul. But the big drawback is that illiquidity. It can trap your capital in a slow-moving asset just when you might want to shift things around to fight inflation more actively.
So the liquidity is the main difference here.
It's a huge advantage. That potential for enhanced liquidity means you can react much faster. You could potentially sell out of tokens representing properties in regions with bad inflation dynamics and quickly redeploy that capital into assets or areas better positioned to keep pace. The fractional nature also lets you build a really diversified portfolio across different property types and geographies to specifically target inflation-resistant income, even with less capital. Plus, the DeFi integration offers possibilities you might be able to put your tokens to work, earning yields that could potentially outpace inflation, something you just can't do with a static building you own directly.
It takes that core inflation hedge idea of real estate, but adds layers of speed and flexibility. Let's zoom out again. What are some of the potential long-term societal benefits of this democratization of access you mentioned earlier?
The societal impact could be really significant, especially in, say, emerging economies or communities that have been historically underserved. Financial inclusion is a big one. Just lowering that barrier to entry means people with less capital can actually get fractional ownership in productive assets, like real estate. That opens up wealth-building opportunities that were just impossible before due to cost and complexity.
And could that directly help local communities?
Absolutely. Tokenization could enable local capital mobilization. Imagine communities being able to invest directly in and benefit from local projects, maybe affordable housing, community solar farms, things like that. It helps keep wealth circulating locally and gives people a stake in their own community's development.
And the transparency aspect must be huge in some parts of the world.
Oh, massively important. The transparent, immutable record-keeping of blockchain could seriously cut down on the fraud, corruption, and disputes that often plague land ownership and transactions, especially where property records are maybe less developed or opaque. That builds trust, which is fundamental for economic development. By offering a more transparent and efficient way to finance things, tokenization could speed up needed infrastructure projects. And think about this. Fractional ownership creates a verifiable digital asset that could potentially be used as collateral for microloans, empowering individuals and small businesses who lack traditional forms of collateral.
Those are really powerful possibilities for broader economic empowerment. One last piece of future tech: central bank digital currencies, CBDCs. How might they interact with this whole ecosystem? Could they speed things up?
CBDCs could definitely be a major catalyst, yeah. They would essentially provide a direct, instantly settling, programmable form of digital government money that could integrate natively with these blockchain platforms.
So the money transfer could happen just as smoothly and instantly as the token transfer itself.
That's the idea. It could eliminate the need for routing payments through the traditional banking system for settlement, making transactions atomic, happening all at once and nearly instantaneous. Using a sovereign-backed currency like a CBDC might also reduce counterparty risk and could make regulators more comfortable, potentially leading to more supportive regulations for tokenized assets, as concerns about illicit finance might be lessened.
And you mentioned programmable.
Right, CBDCs could be programmed. This is perfect for automating payments using smart contracts tied to the real estate tokens. Think automatic rent collection flowing directly to token holders, or dividend distributions, maybe even automated property tax payments happening seamlessly. And as CBDCs potentially become more common globally, they could create a kind of common digital payment language, making cross-border tokenized real estate investments even easier and boosting global liquidity.
It really sounds like CBDCs could provide that final piece of the puzzle for truly seamless global tokenized real estate markets.
They certainly have that potential to significantly accelerate adoption, yes.
Now look, while all this potential we've discussed is clearly enormous, really transformative, it's important we also acknowledge there are still hurdles, right? This isn't all happening tomorrow.
What? Absolutely. Getting regulations aligned across different countries, that's a huge task, and it's ongoing. Developing standardized ways to value these new tokenized assets that needs work, collaboration between the digital asset folks and traditional finance. And there's still a big job to do in just educating traditional financial institutions, regulators, and frankly, the general public about how this all works, so the security, the benefits.
Yeah, getting the established players comfortable with a whole new way of doing things, that takes time and effort.
It does. But, despite those challenges, the direction of travel seems pretty clear. It's towards more liquidity, more access, more innovation in this space.
So just to kind of wrap up this deep dive, we've really traced a path from, illiquid bricks and mortar to these potentially dynamic, bankable digital blocks.
Yeah, we've seen how it's this powerful mixed tokenization tech, the vital legal structure of SPVs, and finding those supportive jurisdictions that's driving the change. And then layered on top, you have these emerging technologies like DAOs, AI, maybe CBDCs, adding even more possibilities and efficiencies.
And the implications are just huge, right? Affecting everything from how individual investors like you can access and diversify to how projects get financed, improving transparency and holding out this promise for broader wealth creation, maybe more financial inclusion.
It really is fundamentally reimagining how we think about, invest in, and get value from real estate. The focus shifts a bit from just the physical building to the digital architecture that unlocks all this new access, efficiency, and flexibility.
So here's maybe a final thought for you, the listener, to chew on. What does a world truly look like where real estate becomes this globally liquid, digitally managed, maybe even collectively governed asset? What does that mean, not just for your investment portfolio, but for the very essence of property ownership, how our cities develop, how wealth is distributed in the decades ahead? The possibilities, and indeed the questions, are pretty profound.